You've taken a big leap. You have become a professional. You're going to start your business. I know you're wondering, should I get incorporated or should I stay as a sole proprietor? Today we're going to talk about that. This is a conversation that I had recently with a coaching client, so I figured it would be great to share it here. And I'm going to talk about the tax and legal advantages and disadvantages of both. Let's talk about generally the more common topics, which are legal status, liability, taxation, and flexibility. There are a lot more differences, but let's just do this for a high-level conversation. So first of all, legal status. If you're a sole proprietor, the business is the same as the owner. There's no difference. Whereas if you're a corporation, you're seen as a separate legal person, meaning you're an individual. Corporation is also seen as a separate legal person. And that's helpful, quite frankly, from a liability standpoint, especially for a corporation. Because if you are a sole proprietor, you have unlimited personal liability. But if you're incorporated, the corporation has limited liability protection. Now, there are certain instances where you may be personally liable, depending on the situation. But again, we're talking in broad strokes here at a high level. Let's talk about taxation. If you're a sole proprietor, the income tax that you pay will be at a personal rate for everything that comes in. Whereas if you're a corporation, the corporation, again, is seen as a separate legal person, and so they're taxed separately. Lastly, let's talk about flexibility. It's quite simple to set up a sole proprietorship. You could, you have to register, of course, with a regulatory body. You obviously want to set up accounts and things of that nature, but quite frankly, it's just admin work. Corporation, not so simple, more structure, a lot more reporting, a lot more compliance is typically required depending on your situation, especially if you're going to start hiring folks within that corporation, right? So generally what we see here is that sole proprietor is easier but exposes you to personal liability and personal debts, whereas a corporation provides you with certain protection from a legal standpoint, and it will also provide you with tax opportunities, which we're going to speak about next. At a corporate level, and depending on the province you're in, it ranges, right? 9%, Ontario, it will be 12.2%. So I use 10.5% here, but just know that depending on your province, check out your province, check out the amount. And the benefit here is you have a small business rate of approximately, whether it be 9 or 10 or 12% on the first $500,000, depending on your province, of active business income, right? And that is a great advantage from a tax perspective versus the personal tax rate, which progressively increase. And so you're looking at, starting at, say, approximately 20% up to as high as 50%, 53.53 for Ontario. So the challenge here is, of course, at an individual level, if you're a sole proprietor, you're paying a lot more taxes. So yes, it's easy in setting up, but you kind of pay for it from a tax perspective, right? Now you might say, well, if all the money I earn just goes right back out from a corporation, then, the extra administrative costs of paying yourself a salary and setting this, because of course you often have payroll that's done for this. You're paying someone to do that, and you have the admin costs of the corporation and things like that. It may not be cost effective, may not even be tax efficient. I think this really starts to make a difference once you start having retained earnings, which leads to the next things, which are the reasons to incorporate. You have an opportunity for tax deferral. So if you have money that you don't need, that you could leave in a corporation to grow, the benefit here is being taxed at a lower level for the money that stays in, and it gets to compound over time. So that tax deferral allows for quite a bit of tax efficiency. Now, if all the money that comes in a corporation is immediately paid out, technically your tax rate is going to be the same whether you're a sole proprietor or a corporation, because you will have treated that as salary, as a incorporated professional, or you could you're treated as all income at a personal level. Now, the one of the advantages, you could probably take that money out as a dividend, but I find for incorporated professionals, a lot of times they want to have the salary because they want to position it for mortgages and different opportunities that come in with showing a salary. The other opportunity for incorporation is income splitting. No, if you're an incorporated professionals, understand that historically there's some limit to how this is done. So in terms of, you could pay family members, but you have to be careful of the rules. But just know that there's opportunity for that. The other thing is finance purchases. A lot of times if you have a corporation, because it's a separate legal entity, using corporate tax dollars to acquire equipment, leases, and other business assets are often more efficient. And quite frankly, depending on the type of loan you're going for, sometimes they want to see that is tied to that corporation, especially if you have other individuals working in that corporation and it has quite a bit of revenue. Another benefit for incorporating is that you could build retirement wealth. Again, this money that goes into this corporation is taxed at a lower rate and it's tax deferred. And so what happens is you have the ability to reinvest after tax profit inside the company, which creates a powerful vehicle for long-term wealth accumulation. But know, like all things tax related, there are rules to how much you could have grow in the business before you start to have some tax challenges there. But just know to start, that is an opportunity. Let's talk further about finance and assets. Having a corporation it provides a huge advantage from a tax efficient standpoint, because, for example, if you're financing $100,000 equipment, say you're a dentist, and if you have to earn all that money personally first, and then financing that money, what you find is that may not be the most cost efficient method, because again, you get the tax advantages of having a corporation because it's taxed at a lower rate, and so those retained earnings or the money that you have there that you would use to finance that equipment's going to be, obviously it's going to cost you less in pre-tax income to acquire that asset. And so you have an advantage here because you pay less taxes, you have more after-tax dollars to finance that equipment. So financing, especially for incorporated professionals who are buying equipment, huge advantage there. Let's talk about the steps you put in place to incorporate. And by the way, so far you've kind of seen from a tax efficient standpoint, especially if you retain earnings, being incorporated is a huge, huge, huge plus. So if that is your decision and that's the one you make, what are the steps to doing that? First of all, you need to obtain professional approval. So based on your regulatory body, you want to reach out to the association and figure out what are the steps, what needs to happen, what's the process, paperwork, etc., etc. There are some ownership rules depending on your regulatory body and your profession. Only licensed professionals holding voting shares, for example, in certain situations. Family members may hold non-voting shares, but then again, even then, it's under certain specific conditions. You want to speak with your lawyer about that just to make sure you understand it. Another thing is you want to review existing agreements. You want to examine the liens, loans, contracts, and in certain instances, you want to get consent from third parties if you're going to transfer assets that you had personally over into the corporation. And lastly, you want to establish legal substance. What that means is ensure that the corporation operates with proper legal structure, which means separate accounts, corporate minutes, formal contracts, and you want to have things done properly where that's concerned. Now, you might say, okay, I have all these assets, and you talk about transfers. What does that look like? The benefit also of having incorporation is that you could transfer the assets without having what's called a disposition. And disposition is, for lack of a better term, is considered a sale, right? The benefit here of having personal assets, especially if you've started a business for a while, is that you could incorporate and transfer those assets into the corporation. So incorporation can be structured as a tax-deferred transaction under what's called a subsection 85(1) of the Income Tax Act. And it's a very powerful provision because it allows professionals to transfer business assets to new corporation without triggering immediate tax consequences. And again, broad strokes, it starts off by transferring those assets. You file an election, a form T2057, and then you choose the actual amount that you want to elect in terms of what the transfer amount is, right? So when using Section 85 for tax-deferred incorporation, you could choose the elected amount or the value at which you're transferring this asset, right? And you could be strategic by selecting an amount that optimizes your tax position. The three choices are: you could use a lower amount, which is just a cost basis. You could use an elected amount, the value a corporation agree upon for transfer. You could also have an upper amount, fair market value, which may trigger taxes. No, but yeah, and from a tax perspective, especially if you're in a lower bracket, you may want to do that as opposed to doing that at a later date. So the election amount determines your tax liability on the transfer, and also the corporation's cost base for assets, which is an important concept for accounting, because that amount is what's used for disposition and depreciation at a later date. I know this might be a bit heavy, so you want to work with a tax advisor, with your accountant, financial advisor, in selecting that optimal amount. Quite frankly, the lawyer should be in this conversation also, tax lawyer specifically, right? Now, I know I talked about some technical stuff here, and if you have questions, feel free to ask in comments. But the general takeaway is that the choice is based on the type of protection you have, right? So being incorporated provides you with being a separate entity for, especially where personal assets are considered and you want to protect yourself from business risk. So having a corporate structure is pretty helpful, but it does come with, you know, admin, a lot of admin work and a bit of headache, quite frankly, sometimes with filings. Being incorporated provides you with significant tax deferral, so that is a great opportunity there. Whereas being taxed as a sole proprietor, especially once you start earning decent figures, you know, you will be taxed at a higher amount. Whereas if you're incorporated, you could take a salary if you don't need everything, keep your retained earnings in the corporation, which is taxed at a lower rate. Another advantage of being incorporated is that you can enhance your wealth building strategy, because you have opportunity to reinvest at a lower rate to a certain limit, because if you have too much passive income, there are disadvantages to that too. And know that if you already started and you have assets that you're using for the business or even personally, what you can do is you could transfer those assets into the corporation, and you could do it at a tax-free selection if it makes sense from a planning standpoint. So hopefully this was helpful. I know some of this is a bit technical, which is why a lot of times people hesitate to talk about this stuff, but hopefully you grasp some of this. You may need to watch this 1 or 2 times just to get a good sense of it. But generally speaking, those are the things at a high level that you consider before getting incorporated. See you all in the next video. Take care. Bye. Like, share, subscribe.